the equity financing I want to discuss next. What do you think is best for property businesses?
Now, that's a tricky question.
We like to ask tricky questions. I like how you're thinking.
There's a whole host of answers, really. So why don't we go back to sort of 101, really, to understand the difference between debt and equity.
Yeah.
So if we just start with debt, debt essentially is a loan. It's as simple as that. You go to a bank or you go to a bridging company, you ask to borrow X amount of money. So if we use the theme that we've talked about, if you're getting a bridging loan, 60% of the purchase price is probably what you're advanced. It's very, very simple. You could go to a private individual and you could borrow money on a private loan. It's not profit share, it's a private loan. Agree a formal arrangement through your solicitors on how they get paid. And that's debt. So you've not given away a piece of the pie. Now let's switch to equity. Now equity gets interesting because equity is essentially, you're potentially giving away a slice of the pie. So it could be a profit share. So you could go to one or two investors, are you prepared to invest X for a return of Y? Now, your question was, what's the most appropriate piece? It really depends on the project, because if we use our traditional bridging example, if you don't have enough money, you'll be advanced 60% of the purchase price. So you're now short 40%, and if it's a development, you could be short even more. So you could be prepared to give away a slice of the pie as equity, as a profit share. Now here's the thing that you need to be very careful about. You can't stand in a room or go online and promote profit share to people who are not the right audience. It's illegal. And if you did find a private investor and you said you'd give them a profit share and they were not a sophisticated or a high net worth investor and it went wrong, you stand the risk of them potentially suing you. So you've got litigation. Now I know people think I'm a little bit mad, but these are the rules. If you read the FCA rules, it's crystal clear. So I thought it might be worth
best to know them in advance and not be caught out by them.
Absolutely. So what do? We borrow money from investors. It's very simple. So we'll speak to Fred. We might be short 100,000. Fred, can I borrow 100,000 for projects that we're funding or projects we're doing ourselves? And I'll agree to pay you X amount of interest. So it's a set rate for an agreed period of term. That's fine. If we are then offering profit share, let's just look at the two types of people that we can speak to. You can research this if you go and look at the FCA website. Well, let's just get a couple of these clear. So the first one would be a high net worth investor. So a high net worth investor, there's essentially two key criteria. One, you need to be earning £100,000 a year in income, and they can self-certify this. So your high net worth, you can certify and prove that you earn £100,000 a year. The other one is you must have £250,000 in assets that can't be equity in your main home or the benefit of a pension or some life insurance policy. So it'll be additional funds, and that's a high net worth investor. So someone who can self-certify and prove that, they could invest with you for profit share. The other one would be what we call a sophisticated investor, so an SI, and a sophisticated investor, there's four key criteria there. And essentially keeping it simple, and there's a lot to remember. Number one, have they invested in a business angel network for 6 months prior to the date of self-cert? So if they have and they can prove that, that's okay. Or have they made one or more investments in an unlisted company in the 2 years prior to the date of self-cert? The third one then is, have they worked in a professional capacity in the private equity sector, raising money for SMEs, small to medium enterprises? Or finally, been a director for the previous 2 years in a company which has a turnover of over £1 million. I know it all sounds very complicated, but if you get that right, you're promoting to the right high net worth, the right sophisticated investor, they can do profit share. So you could actually potentially find a project where you could use maybe some debt for the original tranche of money and for the development, and then find some high net worth or sophisticated investors who can qualify, and they can put the balance in, which means you run the whole project and don't put any money into the pot, potentially.
Fantastic.
Is that okay?
Thank you. Yeah, that's great. Thank you.